roundtable discussion on trade finance in Africa. For those who may not be aware, and you may have heard it, I wanted to underline that this session is being recorded. I'll start by highlighting briefly the results of our poll here today. It was just to try and get everybody warmed up. Well, rather unsurprisingly, we have a very clear representation, large representation from Africa. We also have some representation from Europe. More broadly, we have a greater diversity in the representation of affiliations, and I'm very happy to see that. Hopefully, this diversity enriches our conversation here today. Before we get started, we'll just stop sharing now. Before we get started, I wish to outline the agenda for today in broad brush, as well as a few housekeeping rules, if you like, aimed at facilitating our conversation here today. Following this introductory bit, our substantive discussion will be in three main parts. The first hour and 10 minutes of today's session will be dedicated to our distinguished guest speakers, who will each provide a 10-minute overview of their respective area of focus as was outlined in the program. This will then be followed by a moderated question and answer session. Thereafter, our moderator will provide a 10-minute wrap-up, highlighting the main takeaways of today's discussion. With this program in mind, I encourage all of you to play a dynamic role in today's conversation by posting questions on the substantive issues being discussed to the Q&A forum on this platform. Please use the Q&A forum only and not the chat function. Still with respect to questions, we invite you to ask your questions as soon as they occur to you. Don't wait for the dedicated Q&A session. We'll be keeping a close eye on the questions as they roll in and establish how best to engage with as many of them as possible. Now, I must apologize in advance because it is inevitable that our distinguished guest speakers, despite their best efforts, will likely not be able to get to all of your questions. So apologies in advance for that. However, hopefully, we can still have a rich and fruitful discussion with the questions that can be addressed. With these many words, I invite the head of the Regional Trade Policy Courses Unit here at the WTO, Mr. Roberto Fiorentino, to provide the context for this virtual roundtable and welcome our moderator. Thank you, and I wish you all an interesting discussion. Thank you.
Thank you, Shibole, and a very warm welcome and good morning to you all. Thank you for joining us from Africa, from Europe. It's nice to have a very diverse audience joining us today. As Shibole has mentioned, my name is Roberto Fiorentino, and I'm the head of the Regional Trade Policy Course Unit of the Institute for Training and Technical Cooperation of the WTO. So I would like to thank you for joining us today for this roundtable discussion on trade and finance, obstacles and opportunities for Africa. I would like to welcome the moderator of this roundtable discussion, Dr. Hippolyte Fofak, and our panel of distinguished speakers who will animate this discussion with their wealth of knowledge and expertise. So thank you all for being with us today. Before I hand over the floor to Dr. Hippolyte, allow me to make a few brief introductory remarks and highlight the context that brings us here today. So this roundtable discussion will mark the conclusion of a 14 weeks long WTO Regional Trade Policy course for English-speaking African countries, jointly organized by the WTO, Institute for Training and Technical Cooperation, and our partner, the University of Mauritius. And I would like to extend our welcome to our bio colleagues joining us from Mauritius. The course started on 17th of May and is being attended by 26 government officials from 16 African members and observers of the WTO. And here again, I would like to extend our thanks to our course participants for being with us today. Regional trade policy courses are one of the main trade-related capacity building programs run by the ITTC. Their objectives is to enhance the human and institutional capacities of WTO members to ensure that they can take full advantage of the rules-based multilateral trading system. Regional trade policy courses pursue this objective by providing in-depth training on the WTO agreements, the functioning of the WTO, its rules and procedures. They also provide a unique focus on regional trade policy issues. The aim is to raise awareness of the relevance of the WTO in the regional trade policy context, and in so doing, also to encourage and facilitate dialogue on multilateral and regional trade issues among key stakeholders. It is in this context that we are hosting today this roundtable discussion on the relationship between trade and finance and its significance for the economic development of African countries during these very challenging times. So without further ado, I'm very pleased to introduce the moderator of this roundtable, Dr. Hippolyte Fofak, the Chief Economist and Director of Research and International Cooperation at the African Export-Import Bank, AFRIXIM. Dr. Hippolyte has more than 20 years of experience in the areas of development economics, international trade, banking, and international finance and academia. Prior to joining AFRIXIM, he was with the World Bank Group, where he served in several capacities, including as senior economist and head of the macroeconomic and growth program. So Dr. Hippolyte, thank you for being with us today. You have the floor, sir.
Thank you very much. I think we should be thanking you for what has been done by WTO to really bring the world together in terms of expertise when it comes to trade and trade finance. And I think in that regard, and on behalf of all the leading speakers, and that will be actually carrying through the session today, I would like to really thank the WTO Institute for Technical Cooperations for the inclusive approach that we've adopted to guide these important sessions. I would also like to thank WTO leadership through you for, quite frankly, what I call the extremely timely and relevant sessions that we have today, and leading up to after 17 weeks of sessions. And trade and finance, obstacle and opportunity in Africa. We could not have had a more opportune sessions given what is happening around the world. And coming back to the African context, I think it's fair to say that trade is such a critical determinant of finance in Africa, appearing as both opportunity when it comes to catalyzing, accessing financing during favorable terms of trade, but also as a major obstacle during adverse terms of trade, which are often exacerbated by the pro-cyclicality of financing. So the trade and finance relationship within the region is also largely dictated by the commodity price cycle in a region where the majority of countries, if you go by the latest UNCTAD report, about 45 are still very much commodity dependent, state of commodity in the world, which is significant. So the relationship is known as the Bloomberg Cycle and has been well researched empirically. And over the years, if you look at that relationship, the high volatility has heightened the risk and tilted what I call the unstable opportunity and obstacle trade and finance relationship more toward the latter, which is the obstacle side. And this, and reflecting the timeliness of your sessions, is reflected by what happened in the COVID-19 pandemic, which is still unfolding. So Africa, unlike most of the regions, suffer what I call the first round effect. When commodity price collapsed, you saw oil price going negative. And even though COVID-19 had not yet even been declared as a pandemic, but the first round effect were already raging across the continent. And we saw that with oil price on commodity in general collapsing, and with direct effects on total African trade, which actually declined from about $892 billion to $799, shedding more than $100 billion within the span of a year. We saw the same dynamic on the foreign reserve space, where as a result of that first round effect, the foreign reserve, the continent as a whole, decreased from 379 to about 272, again, about $100 billion in the foreign reserve space. That is the dynamic that we see in terms of direct link between trade and trade finance in the first round effect. But the second round effects are also just as important. And because when you look at the continent, which depend heavily on trade for accessing foreign reserve, which depend largely on trade even for fiscal revenue, you can see that after that such a shock, we have implication directly on both current account, but also the fiscal account. And as we see that shock in those two accounts, the implication will be heightening risk perceptions. We saw most African countries simply ejected from international capital markets as a result of that heightening risk perceptions. Then another important aspect in the second round effect, which operate mainly through the financing after the trade channel, was on the capital flow side. We have either sudden stop of massive outflows of capital from the regions. And so you can see the link between trade and finance, which is really a nice way of putting this topic. Still on the second round effect to the financing channels, we have what we call the large-scale withdrawal of international bank from the trade finance landscape within the continent. Perhaps started all in 2008 financial crisis, but it's become a permanent features of African trade. And the bank, in partnership with the African Development Bank and UNECA, actually conducted a survey last year to assess the potential impact of COVID-19 on trade finance within the African continent. So there was massive rejections of LC, letter of credit, and the two main reasons provided by a banker across the continent were essentially sharp decline in correspondent banking, decrease in correspondent banking relationship, and liquidity constraint. Liquidity constraint, as you can see, come from that trade channel. So those are some of the challenge that we see in terms of relationship between trade and financing within the African continent. But one direct consequence of that, which relate to the topic, is that to actually mitigate those current account and trade deficits, countries naturally have to go and borrow at much higher cost. In other words, they need that dollars, hard currency, to address the balance of payment crisis. And to do that, in a context of heightening risk perceptions, they have to pay the high premium. And that essentially has set the regions on the path of perpetual or structural debt overhang, which is a major risk looming across the continent. So it is really wonderful connections you can see between trade, finance, and debt across the continent. So this is essentially, in terms of background, some key aspects that we see on the trade and finance nexus. In fact, I should say the trade and financing nexus within the Africa regions. And this is what we are going to be reviewing throughout these important sessions. And it will be an opportunity for us to get much deeper into that nexus and relying on the expert we have leading these important sessions. But we're not just going to focus on highlighting the challenges, the obstacle, the nexus. We may also have to explore some of the potential response to the challenge facing the region, looking at that trade and finance nexus. And specifically, what role can actually financial innovation and technology play in reducing those risks, lifting some of those constraints, in particular, if you look at the issue of liquidity constraint and excessive reliance on the US dollar for financing African trade, and could be the potential option that we have on the table. And another important aspect, which is not really due to the external environment, but which has tremendous implications especially for access to financing and for women in particular, is the fact that in addition to that global environment where we have really challenge accessing to financing, and or those who can access will do that at very high borrowing cost, is what I call the financial repression at domestic level, whereby we look at domestic credit GDP within the African continent is a single digit in several countries, in more than 100% of GDP. In the UK, for instance, above 75% in China. But I think Africa is really on the financial repression side. So that's another aspect, the domestic financing, the fact that, in fact, we have limited options either through the domestic capital market or financing from commercial bank within the continent, with implications for access to financing, especially for women. So we're going to be looking at all these issues and drawing on really a wide range of experts and diverse background that we have on this panel to really have a very vibrant exchange between the lead experts and the participants. I think we already have more than 200 connected, which is wonderful. And to take us through this first important part, it's really looking at that trade and finance or trade and financing nexus and potential implication, looking at both opportunities and also the challenges, obstacle. It's no other leader than my good friend, Dr. Mark Oboint, who has really been looking at this issue closely, and not only from the African perspective, but also from a very global perspective. And he will actually not just look at the issue from the African standpoint, but draw on that global expertise to really provide some highlight as to what should be done to begin to address those issues. So without further ado, let me invite Dr. Mark Oboint to take us through the first issue that we are covering today. And I think there's no need to really enter Mark Oboint. He's a well-renowned expert on this topic, and he's been with WTO in the research department for some time, but before that, he works also in Washington at the IMF. I think in addition to really looking at that portfolio, he's also been the one managing international institutions and IFC, the World Bank, and IMF, bringing them together to ensure that we sustain the financing of trade, even in the midst of global challenges where we tend to have pro-cyclicality of financing affecting overall deployment of resources toward the continent. So let me invite Dr. Mark Oboint to take the floor, please. Thank you.
Thank you, Hippolyte. Thank you very much, and hello to everybody. Welcome in the WTO. I am physically in the building right now. What I would like to do right now is just to, since it's also a course, is to provide a framework, the idea of the framework under which the WTO is looking at these questions. And so let me start with this. I may not be able to go too much in the substance, but there are also after me a number of very good experts to look at the more specific issues and the substance. But let me remind that in the 5 core functions of the WTO, Article 3 of the WTO, there is the objective of achieving greater coherence in global economic policy making. And in doing so, the WTO shall cooperate with the IMF and the World Bank. And in trying to understand what means achieving greater coherence in global economic policy making, what were the preoccupation of the trading community in doing so, I think we have to go back to another text which was issued at the very end of the Uruguay round, and it has all its importance because you will see its very relevance. It's called the Ministerial Declaration on the Contribution of the WTO in achieving towards achieving greater coherence in global economic policy making. That's what we call the coherence mandate of the WTO. And actually, among the WTO, the IMF, and the World Bank and other organizations, we are the only one to have such a coherence mandate. So just to emphasize the importance of it for our members, and what our members are saying is the following. ministers recognize that the globalization of the world economy has led to growing ever-growing interaction between the economic policies pursued by countries, including interactions between between the structural, the macroeconomic, the trade, the financial, and the developmental aspects of economic policy making. Successful cooperation in another point is although the task of achieving harmonies between these policy falls primarily on governments at the national level, their coherence internationally is an important and valuable element in increasing the effectiveness of these policies at the national level. So they recognize that international harmony of these different bits of policies is very important. And so they keep on going and saying successful cooperation in each area of economic policy contributes to success in other areas. And so they come to the pinpoint and they say greater exchange rate stability based on more orderly underlying economic and financial conditions should contribute towards the expansion of trade, sustainable growth and development, and the correction of external imbalances. So here you have the preoccupation of the trading community and what they're really driving at. And so they pursue in saying that, that the ministers recognize that the difficulties, the origin of which lie outside the trade field cannot be redressed through measures in the trade field alone, meaning that trade policy cannot do it all, right? Cannot bear the burden of imbalances that might have been created in other areas of economic policies. And therefore, the ministers ask for such a coherence in policy making and then entrust the WTO in pursuing and developing cooperation with the international organization responsible for monetary and financial matters while respecting each mandate and confidentiality requirements of each organization. They entrust the Director General to cooperate with the IMF, the President of the World Bank and the Managing Director of the IMF on the implication of the WTO's responsibility for its cooperation with Bretton Woods organization. And I could say with some confidence that this mandate, which is still very much alive, is now expanding also to all kinds of international agencies that we're working with. And just a last leg of this sort of broad institutional framework allowing the WTO, which is a trade organization, to cooperate with other organizations in fields which are intersecting fields, is the creation of the WTO working group by the members at the fourth ministerial meeting in Doha of a working group, which is a sort of committee. It's a little less than a committee. It's not managing an agreement, but it's a working group on trade, debt, and finance. What the members are saying is that we agree to an examination in such a working group on the relationship between trade, debt, and finance to look at an examination of this relationship and of any possible recommendation and step that it might be taken within the mandate of the competence of the WTO to enhance one of the reasons why there is such an interest in the organization about these topics. And I would stop my overall and general presentation there, Hippolyte, for the next speakers to have sufficient time.
Well, thank you very much, Mark, for taking the time. I think very much appreciated. I think I would like to just mention a few things that we keep that in mind so that we can actually come back to those. I think the issue of coherence, policy coherence, it's so fundamental. And we welcome the fact that you actually look at both the WTO and the IMF side of the equation, in part because, as you know, in that space, the framework can be perfect. But when it comes to implementation of the framework, that's where we have issues. And the fact that we have what I call asymmetry of subsidies, which have actually penalized African countries, have actually affected their trading pattern and performance, resulting in what we have in terms of major and structural deficit. That's on the WTO side. asymmetric of subsidies. On the IMF side, I think it's fair to say that we've had many countries actually targeting exchange rate as a way to boost their trade. It seemed to have worked to the point where now twice a year, the US Treasury put out what they call the currency manipulator list, and which had resulted in what really qualify as global imbalance, which had become very permanent. And that is not a scheme that African countries have been particularly successful at, but it has affected them in terms of the directions of FDI flows to the rest of the world, where they've been marginalized, undermining the diversification source of growth and trade as a result of that. So I just wanted to put these two issues out because they are so fundamental to this debate. And hopefully during the Q&A session, we can actually elaborate a bit more to really provide some concrete proposal going forward. And so based on those remarks, I would like now to introduce the second speaker, Mr. Joseph Atamansa, who is with UNECA. He's been almost a veteran of UNECA, although he looks so young on the screen. And he's done a lot actually in terms of capacity building and training. And after the Coherence policy framework, he has now the responsibility of taking us through what are some the nitty-gritty. The main topic today is actually what you're going to be handling, essentially, looking at that trade finance nexus, and then telling us what are the key obstacles and opportunities that Africa could actually garner from that nexus. So without further ado, let me take the floor, please. Thank you.
Thank you very much, Dr. Fafak. And thanks to having me here. So this is an interesting topic that we need to address. And the reason why trade and finance is very, very important is because we all know that we have, Africa has the, is implementing the African Continental Free Trade Area, or the AFCFTA as we all call it. And it's just imperative because when we look at the AFCFTA, it's basically a strategy for Africa's development, because we know that trade is an agent of growth, and through the implementation of the CFTA, we hope to take the economy from a 2 trillion economy currently to maybe about, according to the ECA study, to about 16 trillion by the end of 2060. So it is very, very important in order to have the CFTA. And at the moment, we have close to about maybe 37, 38 countries that have ratified the agreement. And so that is good. Now, having the CFTA itself is one way, but how do you get to be able to trade amongst yourselves? And to trade amongst yourselves, you have to have to create the milieu, which would facilitate the trade. And one aspect of it is to be able to get importers and exporters to be able to find the finances that they need in order to support that trade. Studies by ADB suggest that most of the trade is done through banks, and annually the Africa spends about 46 billion in order to conduct trade within the continent, and that in itself is a very, very good thing. And also, what we realized from the study again, they find that in terms of intra-African trade, we know that intra-African trade is about 17% or thereabouts. But then the amount of, in terms of the whole trade financing that is done for total trade, intra-African trade takes about, about the same amount, about 17%. So in this case, we're supporting, the banks African banks are supporting trade finance. Now, what are the challenges that we have within trade finance? One, I'm sure that one of the panelists will talk about it in terms of technology. And, it's important that we deepen our technology in order to be able to advance on what we call the financial technology, or fintech for short. So that is something which probably inhibits us to be able to be connected with each other. The second obstacle that we face is the question of the borrowing in terms of capital cost of borrowing. And Africa always, whereas other countries enjoy, single digits, low single digits borrowing cost, Africa, if it does well, is probably on the higher part of the single digits, And so therefore there is something which is called perhaps maybe a study done by the Forex Bank talks about the fact that we may have something called a premium, which African countries pay because of the risk attitudes of that. So it is important, therefore, that we need to address these obstacles. The other challenge that we also face is what we call the payment systems. And thankfully, the African Exim Bank has been able to put forward about 8 billion to support in terms of facilitating the payment systems within the continent, all in the aim of boosting intra-African trade. So in that respect, I think we are doing that. But to take it further, I think given that we would have to be able to start looking into what kind of frameworks that we have to do. One, we may want to think about, having what we call trade done with domestic currencies. Now, what does it mean to have domestic currency for trading? Domestic currency for trading is that, there are checks and balances because, for instance, Malawi trades with South Africa. So there is exports that are leaving from Malawi to South Africa. And South Africa, and there are exports also coming into Malawi from South Africa. So there's this question of credits owing, Malawi owing South Africa, and South Africa also owing Malawi. So in the end, they would have to net it out. So instead of always having letters of credit transferred, central banks or banks within the local may be able to facilitate the trade of the exporters. And in the end, governments or the central banks would only have to transfer just the net, given on where you are in that position. And so we have to think about that. We also have to think about the fact that we may want to look at what we call setting up the appropriate macroeconomic framework, which will allow us, and perhaps maybe this leads to what we call the policy dialogue, policy coherence. And therefore, we need to find a way that we have monetary policy works very effectively, and therefore that would take care of the issue of the balance of payments, the exchange rates, and all that. We also want to make sure that fiscal policy is also very, very handled in a prudent manner. I think the moderators talked about the fact of the debt for African countries, but it's understandable that the debt has gone up because most of the monies were used to fight COVID. But we need to, once we get into post-COVID world, we need to address that. A quick one also is that we also need to ensure that there's financial stability so that it helps everyone in that sense that, you don't send goods and all of a sudden there's default payments and there's the markets are not working properly, the financial markets are not working properly. So there's the need to ensure that there's that financial stability. So having said that, I would say the last thing which I want to point out is Africa may want to think about having a financial hub. And a financial center or a hub, wherever it's based, is very, very important because what it does is that it brings in the risk takers, and also it brings in the regulators who are able to manage the risk. And what this would achieve for us is that if we do have that, is that we would have a situation where, in terms of human resources, it's also going to be beneficial to Africans because you're going to spend a lot of resources to have good people, good lawyers, good financial people. And in this sense, that's also going to create the jobs that the youth needs. So we may want to think about that aspect too as we look at the whole question of finance. And I would like to start by saying that, it is a great opportunity that we are all here. It is a great opportunity that Africa has at this moment to see how it can bring its intermediate banks or intermediaries to be able to support our exporters and importers, and to be able to use the means that are available to African countries to be able to fully integrate into the global trading networks, and also to be able to integrate into the financial architecture so as to boost trade on the continent. I'll stop here and I'll respond to Q&As later. I thank you, Mr. Moderator.
No, we should be thanking you, Mr. Mensah, for that important session. I think we are going to have a lot of debates on your session, because really the heart of the overall thematic, and a few aspects on the, if you look at the opportunity side of the equations, I think you mentioned the AFCFTA, and one important aspect that we should put on the table is really the potential benefit that boosting intra-African trade within the context of the AFCFTA will bring to the continent in terms of reducing that exposure to global volatility. And as you know, across the world, international trade growth has been an absorber of adverse global shocks. We see that within the euro area, where it's more than 70%. We see that in Asia. So that's one on the opportunity side. I think on the opportunity side as well, I think we could also, and perhaps, explore the options of liquidity backstop. And we talked a lot about the US Fed extending swap lines to a number of countries, emerging market economies, and also essential advanced economies, to really reduce that liquidity premium, which tend to raise the cost of financing or lead to massive capital outflows from the regions. That's also something that we could actually explore as a potential opportunities to really boosting financing within the continent by mitigating the potential risk. And then another aspect in terms of opportunity side still is really the issue of really diversifying the sources of growth within the regions. And I think we are going to come back to this, because one of the key drivers of liquidity constraint, the key driver of high perception premium, as you mentioned earlier, is essentially tied to that commodity dependency and volatility. And so to what extent we could the opportunity of diversifying the sources of growth be a major engine in actually stabilizing that trade and finance nexus, which was the main topic of the main topic for discussion on this session too. So I just felt that I should put these two issues or three issues on the table, so that we'll actually have this behind our mind when we get to the Q&A sessions, to really put out some key recommendations on the way forward. And I think we now have the chance to move to the third sessions, which begin to look at the specificity of really moving from the global perspective on the topic to look at some specific issues, the sector, the actors, the stakeholder. And in this particular one, and the key aspect will be for us to look at the role of trade finance in facilitating more inclusive trade in Africa. And I think access to finance is a key constraint in having a more inclusive approach to trade within the continent. But there's also the issue of really, when we look at the risk coming with associated with informal cross-border trade, which can actually essentially prevent a growing number of women for actively participating into that. That's another dimension beside the financing. But for these particular sessions, we'd like to bring in Mrs. Susan Oko to really look at how do we make sure that as we advance this important agenda, that we also have the gender lenses to make sure that nobody is actually left behind, and to push for a more inclusive approach to the promotions of trade within the African continent. I think Mrs. Susan Oko is the principal officer in the East Africa regions. And I think she's actually essentially had the responsibility of pushing for affirmative financing action for women within the regions. And she is with the African Development Bank. So without further ado, let me invite Mrs. Oko to take the floor to enlighten us on the third sessions of this discussion. You have the floor, please. Hello. You have the floor, madam.
There is a problem with the connection, Mrs. Oko's connection. So I don't know if she would like to turn off your camera instead of having, in order to have the audio.
Mrs. Oko, can you hear us? Hello.
Good morning, Dr. Fafak. Can you hear me?
Oh, we can hear you, madam. Please go ahead.
Thank you. These are the issues of technology and working virtually. Thank you so much for that introduction. And it's an absolute pleasure to be here this morning to joining this very timely conversation, because I think the topic is really timely in terms of, looking at the role of trade finance in facilitating more inclusive trade in Africa, of course, with a particular focus on gender smart financing. But I also think that is very interlinked, to addressing the challenges and opportunities that women SMEs face in accessing financing for their business. There are a number of statistics and research interventions in the public domain that points to the fact that women are the drivers of African economies, with the female entrepreneurship rate in sub-Saharan Africa, being about 25 to 26% of the total female adult population. So, this means in simple terms that 1 in 4 women starts or manages a business. With that in mind, you would think that, the real drivers of the economy shouldn't have that many barriers, but the reality is that women face several barriers to socioeconomic progress, including a two-pronged challenge of one, trying to bridge the funding gaps as SMEs, and also, the other challenge of having gender-specific challenges that are linked to, culture, education, business environments, and of course, the all-important access to finance. And so in the context of all of this, the Africa Development Bank has committed to intervene holistically in addressing these barriers that face women SMEs access to finance through its intervention called the Affirmative Finance Action for Women in Africa, with the acronym AFAWA. And its aim is to close an estimated $42 billion financing gap for women SMEs in Africa, in which we expect we will unlock, if we're able to achieve that, we'll unlock their entrepreneurial capacity, also increase their economic participation and help to achieve maximum development impact. And now, so looking at these issues holistically, there were 3 critical pain points that the Africa Development Bank decided to focus on in terms of looking to increase women SMEs' economic participation. The first pain point we identified was that there is indeed a finance challenge, wherein women SMEs are, perceived as higher risk in lending, by financial institutions, and also the fact that they lack bankable collateral. The second challenge that was also identified was a capacity challenge, in the sense that financial institutions, in a lot of the instances, lack the requisite understanding of specific needs of women entrepreneurs. And also on the other side, for the women SMEs also, they sometimes also lack the business acumen to run their businesses. And in turn, in terms of their presentation and the structuring of their businesses, are not able to address the needs or provide the requisite comfort that the financial institutions are seeking before they offer access to credit to them. And then the third pain point that we also identified within the bank was having the right enabling environment to support women SMEs' full economic participation. And so AFDB's response to those pain points through the FR program is one, to provide access to finance. We aimed to do this by unlocking $5 billion in terms of funding to women SMEs. And we tend to, this will be done by leveraging the bank's traditional financial instruments, such as trade finance, lines of credit, equity instruments, and of course, guarantees. Within that, it's a two-pronged approach within that. We have the Guarantee for Growth program, which is an innovative de-risking mechanism that will enhance, we expect will enhance FI's, appetite to lend to more women, while also facilitating lending terms, to women SMEs. And then, of course, the other prong is leveraging the bank's traditional financial instruments. All of this will be supported by some funding from the G7 nations. The second approach is to leverage strongly on technical assistance, really through advisory to financial institutions, because we believe that if we're able to enhance the way that they serve the Women's Market Program, then that means there can be a better synergy. And so the technical assistance through advisory will support financial institutions to increase their understanding of how best to support women businesses through developing financial and non-financial services that will address women SMEs. And also on the other side, we'll also strengthen the capacity of women entrepreneurs through trainings in terms of providing critical financial management skills and digital skills to upscale their businesses. And of course, the third pillar, in which AFAWA will address these issues would be around fostering the support of an enabling environment through leveraging key stakeholders such as governments, regional communities, policymakers, all of these to support the right, legal and regulatory reforms that we hope will bring down those structural barriers that affect and impede access and growth of women SMEs. Now, if we think about the sort of holistically, the challenges faced by SMEs in accessing trade finance, there are a number of them. It's said that SMEs are the lead drivers of trade, employment, and economic development. But on the top of that list, in terms of the constraints that they face, really is having access to, credit and funding. And in a lot of cases, cheaper, credit, because in the event that they are qualified to access, funding, the interest rates are usually very high. And then where they're denied this, it's because of a lack of perceived credit worthiness, and of course having bankable collateral. Of course, this is also applicable to both men and women SMEs. Now, bringing it specifically to women SMEs, in environments that are really gender biased, women also face that extra challenge in having the knowledge, the specific knowledge to participate in trade. There's a lot of research that shows that there's low levels of literacy and low levels of knowledge about cross-border regulations and trade regulations and procedures. And this is more prevalent with women, owned businesses than male-owned businesses. Of course, SMEs as well are also they're also affected by trade costs. And oftentimes women SMEs feel the brunt of this because they usually are smaller enterprises compared to the male enterprises. Another issue that we've also seen is that SMEs sometimes lack the capacity to produce what I would call bankable proposals, that are supported by sound financial figures and also business plans, really. So there is that knowledge gap. And so when that is not structured properly, it then affects the ability of the bank to sort of process the transactions effectively. And so one other thing I'll also like to mention is that first-time applicants also face significant challenges in accessing trade finance facilities from banks. But the interesting thing is that, I saw a study that said that, of a bank that lends to SMEs, trade finance wise, only 3% of that pool actually defaulted in their lending. So that also goes to show that there's a strong, business case for lending to SMEs, but it might mean that banks may need to change their approach from maybe relationship lending to more transaction-based lending for the benefits of new entrants. So what can we do to help SMEs, leveraging trade finance? Of course, I've talked about the AFAWA program and how within the remit of the, access to credits, we will be extending trade finance, supporting women SMEs with trade finance. Also, within the broader AFDB Bank, we've recently launched a transaction guarantee instrument that is designed to provide up to 100% cover for non-payment risks to regional and international banks for trade transactions initiated by local banks in Africa. I mean, this is, we hope that this instrument would provide the much needed opportunities for local finance institutions to build relationships with international correspondent banks. Of course, our targets here are broadly SMEs and of course, women-based entrepreneurs. And we hope that as we roll out this program, we're able to expand our reach and make as much impact and progress as we would desire. And I will hand over to Dr. Fofak at this point and look forward to an interactive session afterwards. Thank you.
Thank you very much, Madam. I think we should be thanking you for first being mindful of the time, but also been very balanced in your approach. I think you were not very, what I would call activist. I think it came out very well that you were very balanced. And you highlighted what has not worked. You also highlight the limitations from the client perspective, which is very good. I think, yes, the issue of collateral has been a constraint, but another important issue that perhaps we should also put on the table is the issue of trade informations. I think there's a major trade information gap, which has actually impeded the growth of trade, especially the one carried by women. And there's also the issue of the KYC and the customer due diligence and so forth, and the cost associated with that, which has been a constraint to access financing. And we have a proposal within Afreximbank called the Mansa repository, which actually tried to aggregate all information on KYC information on potential client customer to reduce the transaction cost and ensure that we actually facilitate access to financing and to all. And then you mentioned the issue of bankable projects, which is a major constraint actually in that space. And now there is attempt by the AFDB, but also Afreximbank, to put together project preparation facilities to make sure that we essentially have projects which are ready to finance, ready to be financed when they get to the bank and financing institutions. But the most important point you made in terms of incentive is to highlight the fact that trade finance is actually a low risk business proposal, something that should provide incentive for more banks to be doing that. And the question is, how come it's not happening? And what are the additional incentives that we should put on the table so it can get more tractions and to reduce that bias that we see, whether gender-driven or essentially risk-driven, but something that I hope will come out during the Q&A sessions. And let me now move to the next topic, topic number 4, which is leveraging technology to increase access to trade finance in Africa. I think this is one area which will actually begin to address some of the challenge that you raise in terms of women accessing financing. And it is a growth industry, actually. If you look at the current debate on the shift toward central bank digital currency, the CBDC, and it tells you that we are in this for a long haul. So we may as well, as a continent, begin to get ready for it. And to talk about that today, we have really Michael and Szymanski, and who's really someone who can do both the academia, but also the professional experience, the hands-on, which is very good in terms of that complementarity. I think I would like to invite Michael to really take us through this very important, but also futuristic topic, which hold a lot of promises in terms of both reducing transaction costs within the continent, but also essentially, this is the part I like the most, perhaps reducing the foreign currency content of African trade, especially intra-African trade. So without further ado, let me invite Michael Szymanski to take the floor, please.
Perfect. Thank you much, Mr. Moderator, and a warm afternoon from Mauritius, all the way out in the ocean. So I think all the speakers have raised a very valid point that and challenges that exist on the continent at the moment. Technology depends on who you speak to. At the moment, the financial services sector is going through either an evolution or a revolution. I think the consumer at the end of the day wants more choice. There's still a lot of feeling happening on the ground that too much is being done by too few that impact the many. And so we're seeing this industry or this sector, even though it's nascent per se, over the last 10 years evolve into what we're seeing today on the ground. The digitization of the financial services industry has been happening for years, but there's still a fundamental lack of understanding of what this is, what it entails, and how does it impact everybody on the ground. So from our side and from what we do from a fintech hub, and not only from a local jurisdiction perspective, we're consolidating the space locally, but also, to one of the speakers mentioned earlier, the coherence of what does the technology landscape, the fintech or financial technology landscape look like in Africa. And there's quite a lot of organizations who are driving some of the changes that we'd like to see. For example, the African Fintech Network, which is a combination of 34 African countries, because this continent is fast. It has very many different jurisdictions, different challenges on the ground, but we need to start working together to showcase what we can and how what we can do and how technology impacts everybody on the ground. Because at the end of the day, technology is not only bringing people who've been forgotten back into the formal digital economy, providing them access to financial services or products that they've never had before. With that comes obviously a risk of financial literacy, because a lot of people are not aware of what this means from a greater perspective. So maybe just to set a scene, we're seeing a revolution happening in Africa by using technology in this space. We're seeing costs drop. We're seeing money move freely cross borders. I know you had alluded to central bank digital currencies. It's a little bit of a controversial topic that we can maybe touch on in the Q&A session, because the whole point of digital currencies and crypto, for example, is for decentralization. Because once again, the financial services space is the second most regulated place in the world outside of medicine. So we've got to bring a safety and stability into the marketplace. But how do we do that to allow innovations and the advancement of technology in these fields to flourish on the ground? So we're seeing a lot of change happening very rapidly. And what technology also allows the smaller jurisdictions is to have a level playing field on the global stage. So if you, for example, look at Singapore, if you look at Hong Kong, there are small jurisdictions with large neighbors, but yet they're financial powerhouses, and they're using a lot of combination of technology to be able to achieve that. And in Africa, we have a lot of good starts that are happening from various jurisdictions on the ground. But there's a lot of technology that is being used to leapfrog and provide stability in the system, because at the end of the day, what we need to make sure happens is that money can move freely and quite cheaply from point A to point B. If you look at the remittance space, for example, in Africa, on a yearly basis, I think the last figure was about $43 billion. You know, the fact that we're still 15 to 20% of those are fees, transaction fees, is borderline criminal in 2021. And technology has the ability to not only bring those costs down, and we're seeing a lot of that happening already on the ground, to somewhere between 2 and 4%, but also to make sure that money moves freely from point A to point B is simultaneously in real time. I send you the money right now, you receive the money right now after I click the button. So for the fintech or the technology space has really seen a massive shift, a very quick shift, and it's obviously sent a lot of shockwaves throughout the world, but it creates obviously a lot of challenges, but a lot of opportunities on the ground when it comes specifically to Africa. So Africa in a global context has this unique set of challenges that many continents don't experience on the ground. One of the biggest, for example, facing a lot of the adoption of the technology from blockchain to whatever else you want to describe, and I saw some of the questions already being blockchain focused, is regulation. Regulation is one of the biggest hurdles facing this space, because how do you regulate something where technically, if you look at it objectively, you know, why do so many people need to be involved for me to move my money from point A to point B? And why must all of them kind of have a piece of that transaction? So I know, moderator, you alluded that Susan was an activist. I am, unfortunately, so I drift into that realm a little bit. You know, but for me, the fundamental essence of what technology does is it empowers the people. It allows them to feel empowered and to be able to participate in the digital economy going forward. And the opportunities in Africa are astounding. If you look at the unbanked, for example, if you look at the statistics ranging from Nigeria, 63%, all the way to through the other jurisdictions, a lot of the people on the ground still don't have access to formal financial products, if you want to qualify them as that. And technology has the ability to reach those people should the right infrastructure be in place. And by infrastructure, for example, everybody understands or has heard M-Pesa on the ground, but cell phone penetration in Africa is what, 44%? Internet penetration is still 23%. Out of 1.3 billion people, there's still a lot of opportunities that exist, but we're also seeing a lot of opportunities on the technology side that are able to solve the challenges that people experience day to day. And one of them I'd like to address today is, you know, I'm an ex-entrepreneur. I've run my own business. I dealt with import and export and the trade finance space. And most of the time, for example, from a personal story perspective, the banking institution did not understand, you know, what the life of an entrepreneur looks like on the ground. So how we came about that is, for example, technology came to the rescue, and we saw platforms such as crowdfunding platforms where you're able to raise the finance for yourself as a small business owner through the power of the crowd and people putting together. It provided a different alternative mode of being able to raise capital for your business needs. So technology as an opportunity is there. I'm also very conscious of the time, and I'm sure we're going to have a lot of debates on the Q&A side, but crowdfunding is one of them. Cryptocurrencies, for example, is another one, or digital currencies. You know, we're seeing micro traders in Africa purchasing directly their goods from Asia in crypto because of currency volatility in their own countries. You know, so the application and execution of technology has a lot of challenges. Obviously, how do you make sure that it's safe, cheap, reliable? But also on the opportunity side is how do we make sure we leverage this so that everybody has access to cash, to money at the end of the day? Because a lot of institutions are still looking for collateral, which in 2021 does not make me a bad human being because I don't have an asset to be able to collateralize so that I can raise my money.
Very good. Hello. Hello. Very good. I think we have a wonderful Empire chair who actually instruct us as to when we should stop and when we should move to the next sessions. And I'd like to thank Michael for that really passionate sessions and on technology. And we are going to come back to that. I think there'll be a lot of questions, a lot of the Q&A sessions. In particular, how do we make sure we have the technological infrastructure within the continent to take advantage of technology in the financing space? Now, we are running a bit late on the time, so let's move to the next sessions, which actually move from away from that little corner of trade finance to look at the role of trade finance and more generally financing for Africa economic development and transformations. And to lead us in that important session is no other leader than Mrs. Annette. So let me invite Annette to take over the floor and guide us through this last but not least important session. You have the floor, please.
Thank you very much, moderator. And I would like to thank the Institute of Technical Training and Technical Cooperation for organizing this discussion, and of course, to the panelists for their very, very valuable contributions this morning. And for those that don't know about the EIF, we are a partnership program that supports least developed countries to benefit from global trade opportunities. We are fully donor funded, based here at the WTO in Geneva. And our work is predominantly around institutional capacity building and expanding productive capacity for access to markets, both regional and international. The speakers before me have presented most of the challenges, and I seem to sort of be ticking off different points that I'd intended to speak about. It's the issues that we hear from least developed countries around financing, and our distinguished moderator has summarized a number of these. But before I start, I actually read two very interesting articles in the last few days from one of the local dailies in Uganda, and these really speak to the practical issues that businesses face in trying to access financing. And in one article, a leading journalist and also businessman, very prominent in the country, tried to obtain a loan from the bank, credit facilities from the bank. He had maintained a 20-year relationship with this leading commercial bank. He met all his obligations over the period, and he just couldn't access funding because the bank said that they would only offer 70% of the value of his assets. And now this is a big businessman. And I wondered what that means for small and micro enterprises that don't have the collateral or don't even have these opportunities to be able to engage with the banks in these relationships. But on the other hand, he said that he has a relationship with a bank in the US. They don't know him, haven't seen him in the last 20 years because that relationship started when he lived there. And they've offered credit facilities that don't have any limits. And for me, just having heard from our previous speaker on digital technologies, all of this relationship has been maintained digitally. But how many of the businesses, how many of the small enterprises based out of least developed countries are able to benefit from these opportunities? And for me, a key conclusion was there's probably a disconnect between what the needs are and what is on offer. Another article that caught my attention was communication from, again, a leading commercial bank that said they had lots of funds available, credit facilities available, and no borrowers. Again, it brings to mind what the issue is, and perhaps the need to be able to address some of these challenges around what financing is being made available and what the needs of businesses are. The issue of technology, of course, internet access, I wouldn't go into that, but it's a huge challenge. So as the EIF, one of the interventions that we have ongoing is a training and capacity building initiative, and we've partnered with the Islamic Trade Finance Corporation under the ICC Academy to build capacity on trade finance. And some of the topics that are being covered within this discussion are guarantees, receivable finance, distributor finance, cross-border trade, trade finance compliance, all of these issues that I think are really important in trying to develop, in trying to address the finance needs, but also in making sure that the offerings on the market meet the needs of the private sector. We've talked in detail about the deficit on the continent and how this has been made worse by the COVID-19 pandemic. And the moderator spoke very, very extensively on this topic at the start. A study from African Development Bank also documents the trade finance gap. I'm sure you are familiar with these studies. And I think what's really important is what kind of innovative mechanisms or innovating financing solutions could we bring to the continent that will benefit our businesses, our private sector. And I will share some examples that are out there that have delivered good results from the blended finance instruments and also from impact investments. You may all have heard about the African Agriculture Fund, and this is a private equity fund which ran from 2011 to 2018, and it was supported by a pool of European and African development finance institutions. It was structured as a blended finance fund, mobilizing private capital through an anchor group of development finance partners. And this aimed to create a stronger and more competitive agricultural sector, better able to meet the needs of Africa's growing population. And through 78 projects, the fund reached over 35,000 MSMEs and over 1.9 million metric tons of food were produced. Now, I bring this example because for the continent to be transformed, the agriculture sector must get the attention that it needs in terms of financing. We all know that 90% of the population is involved in agriculture in many ways. Many of the MSMEs are involved in agribusiness and agriculture-related production for purposes of domestic, but also a trade. And transformation needs to happen in the agriculture sector. It's that sector that also has a number of participants that are not digitally connected. So how do we create instruments that address the issue of financing, but also ensures that those financing mechanisms can also take into account digital solutions? This innovative approach, I think, I'll speak about the other example as well, the Beira Agriculture Growth Corridor. I think some of you also might be aware of this, and this is a partnership that encourages responsible private investment in commercially viable early-stage agribusiness with direct benefits for many smallholder farmers in Mozambique. It's these kind of, I think, initiatives that innovative that will help enlarge the total amount of resources available for developing countries and the LDCs to complement their own investments and ODA inflows to be able to fulfill the financing gaps. I will give another example, one that we're also engaging with, and this is together with the International Trade Center, Care Enterprises, and Bamboo Capital Partners, and working together again to ensure access to finance through the She Trades Network, which is wide, and many of you will have heard about it. This is a network that reaches out and supports women businesses to be able to access markets, to be able to become export ready and grow their businesses and entrepreneurs. So through this fund called the She Care Fund, again, this is bringing resources into the continent to be able to help businesses access financing and be able to access access markets and grow trade. Public-private partnerships present mechanisms for governments to procure and implement public infrastructure and services using resources and expertise of the private sector. So both blended finance and impact investments will involve elements of public-private partnerships. And I think we had this point earlier, the need to bring together the different stakeholders to build an ecosystem that responds to the challenges. We've heard that, for instance, considering some of the issues around failure to access funding, like the absence of collateral, that requires involvement of institutions involved in land acquisition and land ownership. Broadly as well, we need to take into account the doing business and investment climate in the country. So the finance issue cannot be handled in isolation. It has to be handled together with different agencies, institutions coming together to devise solutions that are relevant. So I mean, to conclude, trade finance is definitely critical to the functioning of supply chains and the creation of employment opportunities on the African continent. Technical assistance and capacity building will be essential, and filling the gap will require attracting non-traditional investors. And I think this is a direction that we need to look into, devise tailor-made solutions, because the challenges that we have are different, differ, and one-size-fits-all approach will not address this issue. So, moderator, if I will, and given the time considerations, I'll probably stop here and come back later. Thank you.
Thank you very much, Madam. I think it was good to close on you, because really the whole objective of this exercise is about development. And two important aspects that I put on the table for discussion quickly is increasing role of DFI. And everywhere I go and read, the question is, let's bring back development bank. Let's bring back development bank to finance development. Development bank will provide the counter-cyclical response to crisis to sustain trade financing flows during downturn. Another important aspect that comes very often recently after COVID is let's recapitalize the African Development Bank, the African Export-Import Bank, so that through the trade finance intermediate can provide more financing to domestic bank to sustain growth. But I think we planned this session to spend more time with participants who are very knowledgeable. So I think we should move quickly, given that we've missed already 10-20 minutes, to the Q&A sessions, to really hear from our participants who are really those who are on the trenches and will guide us a lot in terms of key recommendation emerging out of this important exchange. So let's bring back Q&A. Let's bring back the question from the participant, please.
Yes, Dr. Fafak, the questions from the participants are now available. You can see them by clicking on the Q&A button.
So we have almost 18 already.
Indeed.
Exact. So I think we have a very good set. I think the first one, and how do we actually get this fast tracked and get the regulator on board to move faster, the blockchain? So it's on the technical side. Let me invite Michael to address that first one, please.
Perfect. So
it's from Andre.
Perfect. Thank you much, Mr. Moderator. So that's a good question, and I think every ecosystem, not only in Africa but around the world, is trying to solve. But I'll answer it as best we can. So let's start off with the basics. The regulator's role is to regulate and provide safety and stability in the financial system. Innovation traditionally is there to push the boundaries of what the limits are. You know, so when you have these two working in isolation, you're seeing a big disconnect on the ground, and therefore the regulation is either wrong or doesn't move in the right direction. So I think some of the recommendations and some of the things that have worked on the ground from an experience perspective is the regulator and the private sector in the industry working hand in hand to better understand each other's challenges and roles in the equation. If you look, for example, at the FCA in the UK and even the Bank of England, they have an incubator in-house, right? So they're not an incubator themselves, but they want to have line of sight of the type of innovations that are coming through, so they are better informed on how to regulate those. And we're seeing a lot more of these kind of relationships exist on the ground, and part and parcel of some of the fintech custodians, if you will, in the various jurisdictions, such as the SFF in Singapore, ourselves in Mauritius, Nigerian Fintech Association in Nigeria, and all the other national associations, is to try and bridge those gaps and get the right people talking so they can understand, and therefore work together in making sure that the regulations are safe enough, while at the same time being able to allow these type of innovations to be used in an environment that becomes a win-win for all the parties. So the reason why we're seeing a slower acceptance or movement in the regulatory environment is quite honestly a lack of understanding. The regulators themselves are very good at regulating. The innovators are very good at innovating, and they're not speaking the same language. So one is frustrated with the other, the one doesn't understand the other, and that's where the disconnect comes into play. And what we're seeing more and more happening in Africa is a lot more discussions happening, particularly in light of COVID, because it's forced people to move and change the way they think and how technology is used in the regulatory environment. So I'll share a local story. For example, the local regulators here on the ground have now fast-tracked the sandboxes and other kind of regulatory frameworks to make sure that it keeps pace with the innovation, so that the user at the end of the day doesn't have to go into a bank branch for them to do a KYC process, but they can do it all digitally. So if the recommendation from our side, or the experience from our side, is greater open discussion and collaboration needs to happen between the two various stakeholders for the innovations to be adopted and regulation.
Thank you very much for that extensive response to questions. And I would like to invite perhaps Mr. Mark Oboyne, Dr. Oboyne, to address the next questions and relate to implementation of counter-trade policy to facilitate trade and increase output without relying on hard currency to finance trade in the continent. So to what extent could counter-trade policy help reduce excessive reliance on foreign currency financing of trade? Mark? And related to that, if you could also address that, is the issue of de-dollarizations.
Thanks very much. Here I put my research hat on. Look, yeah, I mean, one of the issues in international trade is the dominance in certain currencies and access to it. And as you know, during the financial crisis, but also again during the COVID-19 pandemic, the central bank of a very, very large country and trader has reestablished its currency swaps with 14 central banks to be able to supply the currency that is dominant in international trade. And so that helps very much during those crises. Without getting into the reason of the dominance of the currencies and so on, I think there's a real effort by a lot of countries to try to promote local currency supply and local currency financing. I think just let me make one remark with respect to trade finance, and that sort of comes from my old research. If you think of countries which grow their trade relatively quickly, that, for example, benefit from the delocalization of let's say, Chinese trade. China is no longer in certain areas willing to do some products, so they are either delocalizing or investing into new country. Then all of a sudden you do have a large demand for imports and exports from the new. And very often you see that the country's savings rate, because of its low level of development, is very low. So if you have a situation where, let's say, it's export or import to GDP rises to 20%, but its savings rate is 4 or 5% of GDP, you have a gap here whereby the local financial sector will not be able to produce more than 4 or 5% of GDP in loans because its savings base is very low. But the demand, its international sector will grow very quickly. And then the demand here for, let's say, import finance or export finance will be very large all of a sudden. And I can give you at least 10 or 15 countries which have been in that situation. That means what? That means two things. One, there are countries that are still highly reliant on importing trade finance. So it means that their macroeconomic situation is such that they would not generate sufficient, as much as you can mobilize domestic saving resources, they will not be able to support with their domestic saving resources so much loan. So they will have to borrow some trade finance. And here, an efficient financial system matters very much, because indeed there are exchange of surplus countries which do provide their surpluses of trade finance supply, and some countries which are sort of net importers of trade finance. And the point here I'm trying to make is, well, on the one hand, there's a need, of course, for financial sector reform, which is not our areas of business, for mobilizing whatever can be mobilized in terms of local financing and in terms of being efficient in mobilizing the resources of local trade finance. But there is also a need by the international financial system to be able to sort of facilitate that access to trade finance to those countries which are developing their trade. And that has been one issue of discussion, not that much, a bit at the WTO, but it's been a lot in the financial sector arena with respect to the correspondent banking relationships, which have been actually disappearing, as you know, as a result of the contraction of the financial system, or at least of a contraction of the network of some of the large banks after the financial crisis, which has, as recognized by the Financial Stability Board, for example, the BIS, which has been hurting more than disproportionately some of the low-income countries. So there are issues within the financial system there that impact the supply and the demand of trade finance, and that we are on a sort of receiving end as a trading community, and of course it matters very much. So developing local financing capacity is one solution. Seeing how also local banks are compliant with international regulation in a way that they are attractive to having their correspondent banking relationship maintained by the rest of the international financial sector is another issue that on which we have been writing, by the way, as a secretariat, trade finance and the compliance challenge. So there are here a number of issues which are broad, not necessarily for the WTO to bring in solutions, but certainly for the coherence of international policy to be thinking about.
But thank you very much, Mark. I think that was a very important and comprehensive answer to an important question. I would like Mr. Mensah to take the next two questions, which relate to the implementation of the AFCFTA agreement, but also related to that, it's essentially how do we make sure there is macroeconomic convergence in a way that will actually support SME growth across the continent, essentially the issue of regional value chains within the continent. So I'd like to invite Mr. Joseph Atamansa to cover those two questions. And you have about 3 minutes for those two questions, please.
Thank you very much, Dr. Fofak. Quick one, in terms of, I think this is Diola's question about.
Yeah, that one is a home run for you. It's on Ghana, actually.
Yeah, okay. So now you've given up my identity then. Anyway, so in terms of the macroeconomic volatility, it is important. Yes, that's why I said earlier, related to that has something to do with the question of having to support the AFCFTA implementation with sound macroeconomic background. So without if there's volatility, then you know it's going to affect your exchange rate. Terms of trade will be affected in that sense, and so payments will not be very predictable. So you need to have that framework so that you have convergence. And as the moderators talked about, you need to do it with the right policy coherence, which would coordinate financial stability, fiscal policy, and monetary policy. It's quick. Now, there's a question also raised by on the question of border closure and how it impacts on that. I'll take it quickly. I think it's not good if we're implementing the CFTA to be seeing borders closed. I think it's something that has to be addressed because that is a stumbling block to free movement of goods and services, and we need to address that. As I have the opportunity, let me take a question by Dr. Akwa on the cost of borrowing. And the cost of borrowing, how do we bring it down? And I think I mentioned that earlier, that the way you do cost of borrowing is it's just risk premium. So there's a perceived risk in terms of how people perceive Africa, that there's a lot of risk there. And so we ourselves have to find a way that we have better rating. And that's why maybe some African countries have started, or our AU is trying to come up with its own credit rating arrangements. And I think that probably would help to address that. And the last part, which another question from Mustafa about financial innovations, I think it's critical, yes, that we get into financial innovation in terms of bonds to be able to issue the type of green bonds to support innovations in the diversification of industries and all that. I know the time is short, so I could not get into in details on all aspect of it.
I think you've covered a lot of ground there, actually. I think it's a lot in terms of moving this forward. The next question, I would like to bring Mrs. Susan Oko. And there are two issues we've not covered. I mean, the ESG came up. I would like to invite Mrs. Susan Oko to cover both the ESG issue, environmental issues, and financing trade, and the KYC issues. And please do take the floor, please.
Okay, thank you. So just looking at the question, so how? Oh, that's okay. This question actually on KYC is addressed to Forex Bank.
I would like to take that, please.
Okay. Well, so I mean, I think for KYC, I think it's a matter of having a streamlined database and ensuring that whatever information is available it cuts across, all of the different parameters. So, for example, if you're looking at, customer coming to borrow, it's important that within that, the regulatory framework of that country, that, the credit ratings or the credit history of the borrower is captured such that if I move from bank A to bank B, there isn't any ambiguity in terms of what information is accessible to the banks. And so therefore, if I've defaulted in bank A, it's important that the credit system is able to capture that such that, the bank B is not exposed to me as a risk, as a risk in terms of wanting to lend to me. So I think it's about, really fostering technology to ensure that, there's a centralized way of capturing information, and also making sure that the requirements are simplified such that the customer is very clear on what the requirements of the banks are. And then I think from a cross-border perspective, perhaps, we might want to look at adopting. So for example, in Nigeria, I would say we have there's a system called the BVN, wherein a customer has a specific unique identifier that is able to identify them and whereby it's able to pull out their history, of transactions. So if within the Africa, the Africa continent, we're able to come up with a solution that is able to address this cross-border, that way lending should be, made easier and more streamlined in terms of, having a cross-border exchange across countries and continents. In terms of ESG, another issue that needs to be addressed, climate change is here. Well, I think that it's really important that businesses begin to take that responsibility and become more transparent in terms of their reporting. What I found is that investors are becoming more particular about what types of what types of businesses they invest in terms of their ability to demonstrate environmental, social, and governance issues around sustainability. I think that it's just important to be sure that as a business, your processes and your way of doing business, and also in terms of securing investments, align with some of these principles, and work in a sustainable manner, and also in the way you engage your suppliers, your communities, and just the way you generally do business. There has to be an intentionality in terms of embedding ESG as a way of life. I just wanted to quickly touch on a question that somebody asked about more information on funding from AFDB, particularly has to do with the East Africa region. I would say if you want more information on that, it's on the AFDB website, so you can check with afdb.org/AFAWA. And then if you're speaking more specifically to the East Africa region, well, I think I'm the person to talk to, so maybe the organizers might be able to find a way to connect us, but we'll be happy to have a conversation if you have a specific financial institution in mind that will benefit from the AFAWA program. Thank you.
Could you also quickly, while we're on it, there's one question asking how to provide to close information gap so that women can have more access to financing, please. 1 minute.
Okay, so I mean, in terms of access to finance information gaps, this is one of the things we hope that the the Africa Continental Free Trade Area will address, because particularly as to do with trade finance, it was an issue that was identified as a gap because women don't have this information. So we hope that through the policies that are being put together through this intervention, that more information will be put out, one, through cascading this through a funnel of women's associations, because we sort of have to collaborate to sort of make sure the information is gotten or is sort of placed to the right people who need it. So this will be a collaboration through women's-based associations, through financial institutions, through even local and regional players, to ensure that more information is put out there as often and as easily accessible as possible for these women entrepreneurs. That's the only way.
I'd like to add, thank you very much, Susan. I'd like to add that African Trade Fair, Intra-African Trade Fair, which is organized every 2 years, actually aim to essentially close that information gap. And I think the next one is scheduled for Durban in November this year, so next 2 months. It's an attempt to address information gaps. On the issue of KYC and customer CDD, I think we have our Mensa repository platform, which is really an integrated platform, which provide up-to-date information on customer and the KYC informations to reduce costs of transaction or processing client informations, and really ensure that the risk cannot transfer from one bank to the other through that centralized repository system. I would like to bring in Annette, please, to really address the issue of capital mobilization through domestic international markets, and how we can actually draw on that to essentially the issue of borrowing offshore, and draw on that to reduce costs and increasing access to financing. Annette?
Yes, I'm here. Unfortunately, that's not my area of expertise, Dr. Fofak, so perhaps I would pass that question to someone else, but I'll go back to the issue that Susan spoke to earlier on access to finance for women enterprises. And I would like to draw those interested in that to the work of the She Trade initiative, which is a partnership that we have with the International Trade Center. Now, there's lots of resources there, and those resources are not necessarily around access to finance, but more broadly around business, about helping women to access information, helping women to obtain information on markets, training opportunities around key areas and gaps on various trade-related issues. So I've sent the link to that initiative as a response to one of the questions that I saw within the questions that I've raised, and I would like to invite those that are interested to please review that information. And we're also available, if I can be reached directly, to share that information. But the question that you asked, Dr. perhaps I will leave some of the experts on the panel to address it.
But I'd like you to, before we move, I would like you to also look at there are several reasons for difficulty faced by SMEs in accessing trade finance, and the issue high complexity and low scale nature of their product. I'd like you to attempt that, the lack of depth in financial skills and so forth.
Yes, as you say, that's a really, really key issue and a concern that we hear from our engagements with the different countries where we work. And again, I refer back to the capacity building initiatives that we have in place. And through this ICC Academy, that's addressing some of the main concerns that we've found. We're looking at how trade finance can stimulate growth across the different economies. We're looking at continuing to narrow the gap, harnessing technical understanding of all those issues. Through this course, we have about 93 participants that are currently undertaking the training. It's really to address those capacity constraints, those gaps that you have raised, and we have also had through this discussion. Again, I can't emphasize and re-emphasize the importance of ensuring that we have programs that are developed that are focusing on key challenges that are relevant and not necessarily broad or templates kind of capacity building initiatives, but those that are really designed and addressing the issues that I've identified. And I think when I spoke earlier, I highlighted some of the areas that this course is targeting issues, as I said earlier, on distributor finance, supply chain finance, compliance, capital and pricing, and really, I can't re-emphasize more how important this initiative is.
No, thank you for that. The issue of securing LC funding for projects in the ARC space and absence of bankable collateral, who will take that one? Agriculture. I may have to invite Annette once again to address that one. It's about development.
The issue on agriculture, would you?
Yes, in other words, the key question here is, how do we secure LC funding for projects? Especially one example is in the ARC space, in the absence of bankable collateral. It's a difficult one, actually.
Yes, it is. It's a very difficult one. And
who take the risk, essentially?
Can I try?
Yes, please go ahead. Yes, go ahead.
This is Joe Atamansa. Well, I think what you are talking about is who should guarantee this loan. That's precisely. So therefore, you're looking at a situation where either the government would be prepared to have a facility using MEGA, which is the multilateral guarantee agency of the World Bank, to be able to help to have that facility to support the SMEs SMEs to be able to have collateral for these organizations. But it also leads to a bigger question that you would want to see how Africa in general would want to get into all types of financing mechanism. There's either crowd financing or venture capital or angel funds and all those things. So I think as part of development of our capital markets, it might be important that you look into that question to be able to address that issue. So bankable, non-bankable collateral, it means the question is that what is critical is the project that you want to embark on, is it bankable by definition of the ADB standards or by any bank? So you have to make sure that it's bankable. And therefore we need to have institutions that, like the ADB, with facilities that help companies to be able to have bankable projects. And then secondly, in terms of the guarantees, I mean, governments would have to probably step in if they feel that the project is viable and has potential for returns, then you could look into it. Now, whilst I have the floor, there was a question by Kimu on in terms of monetary policy, expansionary monetary policy, and its impact on the continent. Yes, during the COVID period, you can see that even in North America, they had to come out in terms of the Federal Reserve Board of America putting a lot of resources available to Americans in terms to support them through the COVID period. I know that African central banks do not have that facility to be able to do that, but they did their best, which to the extent that they could, had a situation where they had to ease credit conditions to make sure that credit was accessible to most people. Now, as we get into the post-COVID, if we're ever going to get there, given that we are now into this Delta virus and all that, but whenever we get there, there has to be a way, starting from the US itself, to mop up the excess liquidity, because of the question is that they are seeing inflation coming up. And if it's inflation is coming up, in terms of the macroeconomic stability that I talked about, you need to address it. So they would have to mop it up. And this would also be applicable to Africa in case there's excess and we are getting into a situation of higher inflation. Now, let me use this moment to talk about the digital currencies, which African countries are some African countries are experimenting with. Look, digital currency is not a new thing, if we have to be honest. It's something that exists because interbanking has been doing that already. But the question is, in this era, whereby we are worried about security and safety and trust, what we have to do is to make sure that whatever currency is issued satisfy the criteria of what money is. Why do we have money? Money is there for, one, for medium of exchange to facilitate goods, two, to be a store of value, and the third thing, which is most important, it has to be backed up by something. In this case, currently the paper money is a fiat money, but backed by the government or a country that is issuing. So any digital currency that comes out would have to be backed by this.
I would like to, because time is really running.
Sure.
So you close on that quickly so we can move to the next question.
Yeah. So I'm done with that. In the sense that I think that it's good that we should have digital currencies, but then we have to be careful that it makes sure that it gives us the security that is required to be able to address that. Thank you.
Staying on the digital currency, and I'd like to bring back Michael. There are some skeptics, and the key question is, what set of regulatory environment do we need to reassure the skeptics in the technology space?
Saving the easiest for last year, moderator. Sorry, am I on? What can we do? I think education is a key to the way of future, the future of money. You know, a lot of people, a few people, you know, where the early adopters understand the technology, the regulators themselves, some of them being early adopters. But I think education will be key to unlocking the full potential of what this means at the end of the day. You know, in an African context, you know, we still use cash, even in Mauritius. You know, I think just over 80% of transactions are in cash or cash equivalents, whereas you've got 100% bank population, right? So how do we bring trust into the process to make sure that there's adoption of the technologies that are available, and that we'll start seeing results on an education side, and that comes from financial literacy, making sure that everybody understands what this means on the ground going forward, and education is the key to unblocking all of those constraints. And I'm not only talking about education.
But the key question, if I may, Michael, is that you know, we even in the IT space, in the telephonic space, in the mobile banking space, we've actually been penalized across the continent by not having an open sky. In other words, when you move from one operator to the next, the costs are huge. In Europe, they have uniform sky when it comes to telephony, in the US and so forth. So if you do not have that homogeneous regulatory environment across continental space, the transaction costs that you mentioned earlier are not going to go down, even if we move towards. So what regulatory environment do we need to make sure that we reduce those transaction costs associated by the multiplicity of operator or framework? Are we on the same page?
Yeah, 100%. So standardization, and I'm with you. I mean, every single day we get queries, you know, businesses opening up or want fintechs from, for example, South Africa, wanting to move to Kenya via different jurisdictions, and there's costs associated with that. So it's a cost of doing business, but the only way you're going to get that right at the end of the day is through driving a coherent regulatory framework, similar, for example, to what Asia did in terms of Apex, where it's an open platform for all the not only regulators but innovators to be a part of, and allowing it the challenges to be solved in real time, and dropping the cost associated to these various regulatory requirements going forward. So just maybe to give you some insight, Comensa, for example, is working on a cross-border digital payment framework. How do we standardize that so that the end goal is to bring the cost element down and eliminate some of the regulatory hurdles that you see, even, for example, Zambia and Malawi, who are next door neighbors. You know, it's totally two different environments. So there's Comensa, there's the SADC region, but I think building one coherent framework that everybody ascribes to, and even building an African standard, gold standard to that, will definitely assist the journey moving forward.
Thank you very much. And the next question, I would like to take this one from Brian Kuti, and it's about the fact that access to Forex is actually tilted to a large company than SMEs. And I would like to invite Susan to really address this one, please. The gap between SMEs and large corporations accessing Forex.
Yes, thank you. The question says SMEs, more so women-led, do not have adequate trade information to enable them expand their trade. So accessing Forex. So I think it all depends. It's really down to the country and the regulatory frameworks. If the country is, you know, if it's a heavily importing country, for example, you will find that, you know, there are certain products, or there are certain importation items that are on a list that can be assessed by SMEs. And then if, you know, if the economy is also trying to drive you know, development in manufacturing and internal trade within the country, then you find that some items are not on the list and therefore would not receive foreign exchange Forex funding. I think it's as simple as that, to be honest. I think it's all really down to the regulatory frameworks and policies that are available in the country in question, and whatever policies they're trying to drive in terms of maybe diversifying, you know, in terms of getting other streams of or increasing their GDP. And that way it will determine what kind of foreign exchange is available as well. So for example, I keep referring to Nigeria because that's really, where I can anchor a lot of my examples. Nigeria is heavily dependent on oil. And not just dependent on oil, it's also very dependent on importation. And so part of what the government is trying to do in this instance is to diversify from oil by encouraging other sectors within the economy. And so foreign exchange is obviously limited to certain parts of the economy they're trying to stimulate, and so will not be available so easily to SMEs. And so therefore it should drive development with the right infrastructure for SMEs to sort of start to produce rather than looking to getting things from abroad. And then of course there are constraints around liquidity issues, and then FX volatility. So again, this sort of response, it's difficult to give a broad-based answer. In my opinion, it would differ from country to country and whatever.
Let me give another pointer. If you could actually elaborate on that. There are accounts which actually target exchange rate. In other words, they will target sector which generate foreign reserve. And to what extent will the AFCFTA shifting the tail toward more intra address that bias? Are you there, Annette? Susan? Susan, are you still there? Hello?
I think we may be having a slight issue with connectivity, and perhaps may also be an indication that we are sort of at the terminus of our Q&A session here. So perhaps over to you, Dr. Fofak, for the wrap up.
So should we assume that we've exhausted the Q&A session and move to the next one, the wrap up?
Yes, indeed. Unfortunately, we're not in a position to take all the questions.
Yes,
thank you.
But we'll make sure to provide written answer to those questions, I suppose, right? That's something we can promise, right? Should we do that? So we are going to attempt to respond to questions that were not covered. We'll try to get back to you on this question in writing. But this has been, as you can see, we're very optimistic. And as we discussed during the design of this course, and the topic as such that each of them will warrant at least an hour in terms of covering discussion. But I think the speaker have done a wonderful job at summarizing the most important challenge and nitty-gritty issue in the respective session within the 10 minutes allocated to them. And Mrs. Shibole was very rigorous, did not actually put any red card and to say that your time is over. So I think we did a wonderful job. And the issue of trade and finance and trade and financing in Africa is actually a very complex issue. It's also the most important issue that we face on the development sphere, as we saw through the different interventions that were covered in the session today. And I think one aspect that we did not really elaborate on during the Q&A, it's the issue of debt, the implication between trade and finance and the consequence in terms of debt. And a couple of years ago, I was reviewing the history of sovereign debt default. And you'll be surprised to know that the first country to default and on a sovereign debt was essentially France in 1812, for that matter. And we'll look at the history of sovereign default, and Africa is actually a marginal player in terms of the number of default on the sovereign lending. But what is common across all this sovereign default is that they are driven either by macroeconomic management, financing the war effort, like Germany, or France for that matter, was Napoleon's, which defaulted, or the issue of excessive dependency on commodities. If you look at Russia defaulting as a result of commodity price collapse. So essentially, the key issues that will emerge from this session is, if Africa is really to achieve sustainable financing, and we definitely have to diversify away from commodities to actually mitigate that risk, which has become a major driver of risk, but also potentially default. As when we look at the history of default, one of the main reasons for country defaulting is essentially the commodity bust. So it's a very important aspect going forward. But moving away from commodity dependency will also ensure that we begin to broaden the fiscal space within the country to reduce the risk of recurrent twin deficit. So that is definitely the way to go. And the fact that we have the African Continental Free Trade Area Agreement in place now actually offer a lot of hope in terms of accelerating the process of diversifications of sources of growth to essentially achieve that desired objective. And this boils down also to the fact that there is mutually reinforcing goal between intra-African trade and industrialization, to the extent that the last chunk, a sizable share of intra-African trade, it's dominated by manufactured goods. In other words, manufactured goods account for a very large share of intra-African trade. So that growth, especially under the rules of origins, will actually accelerate industrializations. And I think there are several other aspects that we may have to revisit. And the issue of really rigorously implementing the coherence framework that Dr. Obwend mentioned earlier, to make sure that, yes, we have a framework. How do we make sure it works in the interest of all? And the issue of asymmetric subsidies has come with tremendous cost. The issue of IP has actually undermined the diversification of African export, as well as the whole issue of non-phytosanitary measure, which actually constrain African export of agricultural product in particular. So those are other issues. We have the right framework, but how do we make sure that that framework works for all? There was a lot of questions, but also skepticism on the move toward technology and leveraging on technology to improve access to financing within the regions. I think it seems, going through the question, that we still need a lot of effort in terms of educating the populations, in terms of highlighting the benefits, but also in terms of clearly outlining the potential risk. It's a new product. We have to reassure customers. As we mentioned, even in the area of mobile payments, we've not really addressed the whole issue of transaction cost because of that multiplicity of actors and regulatory environment. The need to shift toward a homogeneous landscape in the digital financing space is something that we are still working on. But beside the AFCFTA, which is really very helpful, and we also have the Afreximbank Pan-African Payment and Settlement Systems. I think it will become operational this year. It is actually a project and a framework, technological solutions, which will essentially address one of the major constraints to the financing of African trade, intra-African trade, the issue of excessive reliances on hard currency, foreign currency. I think that perhaps within the context of the AFCFTA will address a major hurdle, the issue of liquidity constraint. And we need essentially to have more strengthened coordination across central banks to accelerate the implementation of the Pan-African payment settlement systems, and to make sure that perhaps going forward, and the whole issue of intra-African trade financing will no longer be constrained by excessive dependency on foreign currency. Another area of increasing interest and hope, it's in the correspondent banking space. I think we have a Reflexim Bank product, AFTRAF, which essentially establishing a network of correspondent banking within the continent, which would replace or making sure that the exit, large-scale exit of international bank does not really constrain the financing of intra-African trade or more generally African trade. And we've actually set the goal of onboarding 500 banks, 500 commercial banks across the continent. As we speak, we've actually exceeded 400 already. So we may be able to achieve that goal of having correspondent banking relationship network across the continent to making sure that large-scale exit does not really undermine the financing of African trade going forward. And I think another area of increasing on the positive side relate to the fact that we see in the horizon already a lot of push to recapitalize and development bank, the AFDB and the Afrexim Bank within the continent. I think that move will actually help a lot in not only providing support to domestic banks, local banks through trade finance intermediaries, but could also accelerate the process of industrialization by mobilizing more resources toward long-term financing. The issue of maturity mismatch, which has been a key issue for SME in particular, will no longer be on the table as we deploy more resources toward the financing of African trade, but also toward the process of industrialization. One thing that we did not discuss, which will be very important going forward, is the issue of industrial policies. And we are moving toward a continental approach to trade policies. We will need a continental approach to industrial policies to achieve greater synergy and greater benefit. If you look at what happened in Asia in particular, especially the ASEAN, and they had essentially a regional approach to industrial policies, which help accelerate the development of regional value chains in Asia. I think that's something that we did not discuss, but which hold a lot of promises in terms of not only driving trade, but more importantly, the link between trade and financing. I know time has been a major challenge for us. And let me, at this point, really stop here and invite our host to take us to the next phase of the program. But before I do that, I think it's fair for me to really extend once again my appreciations for the great job, really, the excellent job done by WTO to making sure that we are all on the level playing field when it comes to knowledge and expertise in the area of trade and trade finance, and the link between the nexus between trade and finance as far as African development is concerned. I think they've done a wonderful job really in managing this course, in making sure that everything's in order. And they deserve, I think, in my view, a strong round of applause, not only from the speaker, but also from all the participants. Let's give them a round of applause. Thank you very much. We now have the floor back to you, please.
Thank you, Dr. Fofak. Thank you very much for your kind words. And obviously, this brings to an end this fascinating roundtable discussion. And I'm sure that you will agree, as you rightly said, that we have only really scratched the tip of the iceberg on what is an extremely interesting topic and of enormous significance to the economic development of African countries. So from our side, we hope that this roundtable will stimulate much needed dialogue and spur initiatives to move forward this important agenda. On behalf of the RTPC unit, I would like to thank our distinguished panelists, Susan Oko, Annette Semuemba, Marco Buona, Joseph Mensa, Michael Szymanski, for their very insightful and thought-provoking contribution. And obviously a very big thank to you, our moderator, for superbly managing this discussion and timely management of this very complex topic. I would also like to extend my gratitude to my colleagues from the conference office and the RTPC unit, and in particular to Ms. Cibole Wakoli, who's been the real, I would say, mastermind behind this roundtable discussion. So Cibole, thank you so much for all the work you put in this. And finally, and definitely not least, I would like to thank our colleagues from the University of Mauritius, our course participants, and to you, the audience, for tuning in and contributing with your questions to the wealth and richness of this discussion. Just before we say goodbye, I would just like to inform you that the recording of this roundtable discussion will be posted on the WTO website. That is WTO.org. And we will also be seeking the permission from our panelists to share with you their contact details in case you want to reach out to them. So on that note, thank you very much. Stay safe and stay tuned. Thank you. Bye-bye.
Thank you very much. Thank you.
Thank you.
Bye-bye, Mark.
Thank you.